Hello, and thank you for taking time this afternoon to watch this video we have prepared for you. My name is Laura Clark, and this is Sean Shelf, and we are the founding partners of Reliant Wealth Planning. We know it is a challenging time right now, both emotionally and financially, so we wanted you to hear directly from us. So in a moment, Sean is going to share with you our insights on what has been happening, what we have been doing about it, and what we think is likely to happen going forward. Thank you. Sean?
Thanks, Laura. So this year has been interesting to say the least. So let's look at a recap of what's happened so far. In the beginning of the year, things were progressing fine. We were positive, not hugely so, but the market was in an upward direction up until about February 19th. That's where the market hit its high for the year. By that time, a lot of news started coming in from China and a little bit from our own West Coast about the coronavirus, and that started to affect the market prices. Then we started to have some downside. What started to happen, though, was we would have a really large downtime, and then we would recover back. So we would go down sharply and then come back, and then go down and come back. That kept happening for a while. Then we've hit a slump in here where it continued to go down, okay? As of right now, as of when we film this, the markets are down about 34% on the S&P. Now, also part of what caused this is in the middle of this very large slump, right about in here somewhere, Saudi Arabia decided to do the world a favor and declared an oil price war with Russia. That's part of what caused the continuation of that steep decline. So that's where we are year to date. Now, what do we think is going to happen going forward? Well, Laura and I have always been very frank with you. We don't consider ourselves market prognosticators, and we're definitely not prophets of the market. So we don't really know. But by looking back at other recessions and kind of looking at where we are in the cycle of this market, what we want to do is share with you our best guess of what things are going to look like. And in the beginning, I have some not so good news. We don't think we're at the bottom. We think this market is going to continue down. Okay? Now, to be fair, we think we've experienced most of the downside, but we think there's still some more to come. And this is going to continue into April, May, sometime time frame. We don't know, but we think we're going to see a little more downside. Once we're here, we're going to kind of what's called bump along the bottom, where it kind of comes up, it goes back down. It comes up, it goes back down. Not nearly as extreme as it has been, but we'll do that. And then we're going to come at some point in time, we don't know when, but at some point in time, we're going to experience a very explosive upside move. Some news is going to come out, something the government does, maybe news about the velocity of new cases of the coronavirus. Some news is going to come out where everyone's going to turn around, look at each other and say, okay, we're on the other end of this. And then what we think is going to happen, like I said, is we're going to have an explosive upside where we go up very rapidly. Looking at some other recessions, that very easily could be up anywhere from 10 to 20% in a week or 10 days. That's the kind of speed we're talking about. After that initial really burst upwards, it'll start to slow down. We might even experience a little setback and keep going up. We'll keep going up, but at a slower pace than in the beginning, and then we'll go on and move through the recovery. Now, like I said a couple of times, looking at past recessions, we think is very useful to understand what this one might look like. In the past half century, we've had three really bad recessions. 2007 to 2009, 2000 to 2002, and then going back a little further, 1973 through 1974. Now, when you look at those time frames, you find something interesting. They all had slightly different flavors. Their causes were all different. But when you look at from the market tops in those time frames to the very market bottoms, you find something interesting. In all three of them, from top to bottom, was anywhere from down in the mid 40s to around low minus 50s%. They're really tight with each other. What that tells us, if we're going to kind of mirror that, which would make some sense, from where we are today, depending on where we are, we have another 8 to 15% of downside to experience, which can be a little scary. But as we said, just like in all the rest of these, when the recovery comes, it shoots back up very, very quickly. One of the largest Wall Street analytic firms out there right now just released a report this weekend on what they think is going to happen. And what they've said is they think the market is going to bottom out at S&P 2000. Now, there's nothing magic about that. So I'm not sure if where they got their number from was from looking at these past recessions, but it all works out just fine. Now that sounds kind of scary. Again, that's down about 12% from where we are right now. But if you also look at the other side of their report, because if you're going to accept this, you have to at least understand where they think it's going after that. They said by the end of December 31st of this year, their guess is the S&P will be at 3,200. Now that's only about 100 points away from the all-time high over here at February 19th. Laura and I think that might be a bit optimistic. We don't know that we're going to go that high that fast. I just wanted to give you a flavor of where some of the other people out there are. I kind of agree with their low point. I think we will start to recover very quickly after that. I don't know if we'll get that high that fast, but we'll take a look. So that's what we think is going to happen and where we've been. So what have we been doing as we've been going through this kind of very trying time? Well, there's two stages to it. There are actions that we took before this ever started. So we've been doing things to prep for this. As Laura and I have told you throughout the years you worked for us, we don't know when recessions are coming. We don't know exactly what they'll look like, but we know they're coming. So there's things that we've done. The first thing we did is we worked with you to develop your risk tolerance. Risk tolerance is a combination of what we call your risk appetite, which is how much risk do you want to take or do you feel like taking, and your risk capacity, which is a much more objective measure of looking at your situation and figuring out how much risk can you take or should you be taking to achieve your goals. By combining those together, we've designed portfolios around that. Obviously, that doesn't mean the portfolios can't go down, but what it means is they're designed around those two things so that it's appropriate in the long term for your situation. Second thing we did was we have been stress testing for years and years. For the last 15 years, Laura and I have talked to you when we do financial planning, we look at either what you can safely spend now that you're in retirement or what we are estimating you can spend when you get to retirement. We've told you we do different analytic models to figure that out. This kind of scenario is exactly why we do that, because we're doing that to stress the situation. And two of those things are really appropriate right now. One is we did bad timing. In bad timing analysis, we assume the next 2 years were going to be really bad. Now, in here, I have some good news for you. Even where the market stands today, we are not below the estimates that we were making in bad timing analysis. What that means is for all of you all that have financial plans in which we did bad timing analysis for, we are still within the parameters or the assumptions that we made. So we are still in line with what we had estimated within the plan. So that's actually good news. We're not out of tolerance with that. The second thing that we do here in stress testing is we told you we took our forward assumptions and we greatly lowered them. We did that about 2.5 years ago. So as we've been updating the plans for the last 2.5 years, we told you we took the assumptions of what we thought your portfolio was going to make and we lowered them going forward for the rest of your lives, because we didn't feel like we were going to get historic-like returns. Well, that's now going to pay off because we've already assumed that the rates of return were going to be lower over time than what maybe history had done. So between the bad timing and lowering the forward assumptions, the plans are still very valid, and what we had told you is still in play. A third thing that we did before this all started is in about mid-February, we did account rebalances. Now, what this had to do with, in the beginning of every year, we rerun all the analytics to decide what investments we think work best in the portfolio. You can think of that as making the investments kind of reapply for their jobs. We do that every year. Some years we do that and we don't change anything. This year we did it and we changed several investments. That has actually worked out in our favor, as the investments we changed into just happen to be dealing with the current environment better than the investments we moved out. Now, Laura and I take no credit in saying we knew this was coming and that's why we did it, but that's why we redo that analysis every year. So that's the things that were done before this ever started. Once this kind of market dip started, though, there's other things that we've been actively doing. So these are the actions that we have taken since the start of the downturn. First thing we did is TAPA did trade. Now, for those of you who use this strategy, to remind you, TAPA is a tactical allocation of passive asset strategy, where we're using some math and indicators to decide, well, how much should we be in the market and how much shouldn't we be in the market? Well, back over here on our graph, TAPA traded right around here. It traded in the very beginning of March, and it gave us a signal to say, hey, take 70% of all the assets in TAPA that are in growth and move them to defensive. So that was a pretty major shift at that time. When that happened, the market was down approximately 9%, is when TAPA made that shift. So the market was down 9%. Of the assets in TAPA, we shifted them 70% out of the market, which means for most of this downside that we've experienced, 70% of the assets in TAPA have not been exposed to it. So that has helped us out. The second thing that we've done since the beginning is bonds. We've changed the bonds around. Now, in the beginning of this downside, bonds were doing exactly what we wanted. As we've explained to you, we own bonds in a portfolio to try to protect against a downside market. And they were doing exactly what we wanted them to. But around March the 9th, which would be, it's somewhere around in here, bonds stopped acting in the way we would expect them to. Now, that doesn't mean they started going down as much as the market did, but they weren't going up anymore in a way we would expect them to. They became more volatile than we thought bonds should be. And that continued for a while. Because of that, we made some trades into bonds that were more stable, that weren't showing that kind of up and down movement, because the whole purpose of the bonds is to add stability. So we actively went in and we changed the type of bonds that were in the portfolio. Sixth thing that we're doing here is the liquidity reserve. Again, we've talked to you about liquidity reserves year after year. This year is an example of why we have that. For those of you who are living out of the accounts or have to achieve goals by pulling money on a normal basis out of an account, the problem is, as the market goes down, we don't want to have to sell something that's down to generate the money. However, for a lot of you, we don't have the luxury of saying, we're just not going to send you anything. You're living off of that money. That's where the liquidity reserve steps in. So we have a pot of money sitting there, about a year's worth, that we can pull money out of things that have not had this kind of downside, continue to give you your money, and what we're doing is trying to give the markets time to recover before we have to touch them. Now, the other thing that we're going to do, somewhere around the second or third quarter, we have plans in place to start replacing from the liquidity reserve from the assets that have not experienced this dramatic downside. So we're going to start layering in money into the liquidity reserve from assets, again, that have not experienced that kind of down pressure. The seventh thing that we've done are legacy trades. Now, some of you have assets that we've been holding in the accounts for years and years. They weren't exactly the kind of investments that we wanted, but because of the tax consequences of selling them, we've held them. We had decided, well, this is not bad enough to realize the taxes for, so we'll just hold them. Well, as the market has now dropped, it has given us an opportunity to start selling some of those things and not realize nearly the kind of gains that we would have even just a couple of months ago. So we've been using this opportunity that the market's given us because we fully expect the market to recover. And when that happens, the opportunity will be gone to try to change these investments around without much tax consequence. And then the eighth thing that we have been doing here is taking opportunities for the people that they're appropriate for. Now, what do I mean by that? The opportunities are different for different people. For several of you, we've been doing Roth conversions, where we're taking assets and we're realizing less taxes to move over the same assets that we'd had to pay more taxes for just a month or two ago. And then when the recovery comes, we got more assets into the Roth than we normally would have. For others, you've been adding money to the accounts, and as the markets go down, we've been looking for buy points. So we've been buying on the way down so that when the recovery comes, we will get the advantage of these lower and lower buy points. Now, one of the things I do want to cover with you, though, is something we're not going to do. So here's where we are today. This is an assumption of what we think kind of the market's going to look like. If we draw a line across here, what we're not going to do is make a big mistake. One of the big mistakes people can make in a situation like this, because in the short term, emotionally, it feels really good, is sell it. Just sell it all and get me out. I've had too much pain and I'm worried. We completely understand that. This is very scary time, and that makes perfect sense. However, we feel confident that we've taken most, not all, but most of the downside that we're going to take. And if we sell now, the only way that's going to benefit you in the long run is if we buy back in somewhere below this purple dotted line. That's the only way that strategy works. We have to buy lower than we sold out. Now, here's the thing. That's extremely hard to do because we don't know when this recovery is going to come, one. And two, like we just said, we think when it comes, it's going to happen extremely fast. So it's going to be very hard to try to buy back in below this line, because if emotionally you just can't take it here, what are the chances emotionally you're really going to want to buy it back right there? Laura and I have been managing money for folks. We were managing money in the 2000 to 2002 time frame. We managed money during 2008, and I can tell you, if emotionally you feel like selling now, you are not going to want to buy in even lower, which is the only way that strategy works. So that's why we really don't want to take this on for you. We want to help you avoid that big mistake. So we appreciate you watching this with us. As always, we will welcome any calls that you have, any questions. We're here for you, and we hope you have a great day. Thanks.